Most people notice interest rates when they're deciding whether to borrow money. Economists describe them as something much larger, a price that governs the flow of time itself. This story explains how a small percentage becomes a powerful force. Maya opened her credit card statement and stared at a number that didn't match her mental math. She'd paid $150 last month, but the balance had only dropped by $62. The missing $88 hadn't disappeared. It had been claimed by the annual percentage rate, a 19.99% charge that appeared as a single line on the bill. This is an example of how interest rates function. They're the rental cost of borrowing money, calculated as a percentage that compounds over time. Maya had borrowed $1,800 3 months earlier for an emergency car repair, accepting the rate without considering what it meant beyond the monthly minimum payment. What's happening here is that 19.99% annually translates to about 1.67% per month, applied to whatever balance remains after each payment. Economists describe this as the time value of money, the principle that a dollar today is worth more than a dollar tomorrow because of what it could earn or cost in between. The credit card company wasn't charging Maya for the repair itself. They were charging her for access to money before she technically had it. By month 4, Maya realized her minimum payments were barely outpacing the interest accumulation, creating a treadmill effect. This pattern appears when payments covered the interest charge plus only a small portion of the principal, allowing the debt to sustain itself. The interest rate wasn't a one-time fee, but a recurring multiplier that reset every billing cycle, feeding on duration. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. 200 miles away, a committee of economists gathered in a conference room to debate whether to raise the federal funds rate by 0.25%. This is the Federal Open Market Committee, and their decision affects the cost of borrowing across the entire economy. The federal funds rate is what banks charge each other for overnight loans, and it serves as the foundation for all other interest rates in the financial system. When this rate rises, the increase ripples outward. Mortgages become more expensive, credit cards adjust their terms, and savings accounts offer slightly better returns. This moment reveals how the system works. One interest rate set by a small group influences millions of individual financial decisions. Economists describe this as monetary policy, the process of managing the cost and availability of money to influence economic activity. Maya's savings account interest increased from 0.5% to 0.8%, a change barely noticeable in her monthly statement. But her friend's mortgage rate quote jumped from 4.5% to 5.3%, adding $240 to the monthly payment on a $350,000 house. This asymmetry appears throughout the system. Interest on debt rises quickly and substantially, while interest on savings climbs slowly and incrementally. The Fed adjusts rates to cool an overheating economy. When borrowing costs more, people spend less, and inflation theoretically slows. But the effects take months to materialize, making monetary policy more reactive than precise. What's happening here is that individuals respond to existing rates, while policymakers adjust rates based on future conditions they're trying to influence. Maya decided to pay extra each month, adding $300 to her minimum payment to escape the debt faster. After 7 months, the balance reached zero, but the total amount paid was $2,140 on the original $1,800 purchase. The extra $340 represented the cost of time the gremlin had fed on every day between borrowing and repayment. This pattern appears in reverse with savings, where interest earned generates additional interest over time through compound growth. Maya opened a high-yield savings account at 4.2% and deposited $4,000 to see the mechanism work in her favor. After 1 year, the balance showed $4,168. The $168 had appeared without additional deposits or effort. The crucial difference was time horizon. Interest on debt punishes over months, while interest on savings rewards over years. This is an example of why the system favors existing capital. A $100,000 investment earning 5% generates $5,000 annually without labor. Maya's friend locked in her 5.3% mortgage for 30 years, committing to total payments of $671,000 on the $350,000 house. Nearly $321,000 of that represented pure interest, money that wouldn't buy a single additional room, but was required to access the loan. What's happening here is that interest rates fundamentally alter the real cost of purchases made with borrowed money. A single percentage point difference on a 30-year mortgage translates to tens of thousands of dollars, yet the gap feels invisible in daily payments. 6 months later, Maya received notice that her credit card rate had dropped to 16.5% based on payment history and Fed adjustments. The reduction reflected a recalibration. Her risk profile had improved, justifying a lower price for borrowing.
This pattern appears throughout lending. Interest rates aren't arbitrary, but prices that reflect perceived risk and economic conditions.
Economists describe this as risk-adjusted pricing, a mechanism that channels capital toward reliable borrowers and away from uncertain ones. What's happening here is that interest rates function as information signals, coordinating behavior between millions of lenders and borrowers who never meet. Maya began noticing rates everywhere: car loans, student debt mentions, news headlines about Fed decisions. The tiny gremlin wasn't confined to personal finance. It was embedded in the entire economic infrastructure. This moment reveals how the system works. Interest rates are the price of time itself, governing how resources flow between present and future. When rates rise, accessing the future becomes expensive, borrowing costs more, and saving becomes more attractive than spending. When rates fall, the opposite occurs. Borrowing becomes cheaper, and holding cash loses appeal as inflation erodes its value. Maya realized the $340 she'd paid wasn't about the car repair. It was the cost of the gap between needing money and having it. That gap had a measurable price, and interest rates with a system for quantifying what bridging time actually costs. The architecture remained mostly invisible. Most people would never study Fed minutes or calculate compound interest manually, but it shaped every financial decision regardless. Maya kept her savings account and paid bills in full, not because she'd mastered finance, but because she'd learned to see the gremlin early. The small percentage that once seemed harmless now appeared clearly, a multiplier that turned time into cost or cost into growth, depending on which side you occupied.